Good afternoon. Pre-close comment with about 40 minutes remaining in Gonzo Tuesday Fed-related trading. We expected particularly a discount rate cut, ideally half a point in the discount rate, maybe a quarter in the Fed funds. They went ahead and did a half a point, as you know. I think that's fine. I think we should never underestimate the significance of a properly sloping yield curve, and basically I would say that this goes a long way towards emphasizing what the markets were already telling us, and we're just having some slight contrary moves, as we said, would occur, i.e., if they cut rates more, you'll see rates move up, and that's why you saw the 30-year and the 10-year in particular move up a bit. It's not because of disappointment over the inflation-fighting philosophies of the chairman. But let's face it, a devastating credit crunch is out there, and I actually think the situation in England overnight, what has been shaping up there, contributed to the actions taken in Washington because it essentially collides and the credit crunch fears with the Fed's mandate to protect the purchasing power of the American people. We have cautioned in front of all of this that one be very careful, even if one believes that there's risk of an event, and we are not dismissing that, incidentally, of a negative nature in the market during the second half of this month, and particularly October, for one reason or another. Nevertheless, we think the magnitude of such scenarios is cushioned only to the extent that everybody knows the Fed's bias is in the right direction. We have felt that it has been in the right direction since they intervened even before the break a couple months back and have been printing money at an accelerated rate. At the same time, I think there is too much perception here that all the ills are now cured, but at the same time you don't lean against it immediately. I think what you want to see is this absorbed, particularly tomorrow morning, and then we'll take a look at it, and we'll see whether or not the bank stopping of the Bank of England, of the literally historic deposit situation backstopping, followed by the good news from the Fed confirming what the markets had already told us was forthcoming, then that may give an opportunity that is a reduced risk scenario for leaning against the wind in terms of any heightened expectations of conditions intensifying in a negative nature down the road a bit. But again, I wouldn't be doing so instantaneously, particularly, and this is separate and apart from our intraday S&P guidelines that we give here at ingerletter.com. But I think that as we look at this intraday pattern and we find that we have a long here with a 2-point autopilot that will take us to the short side on a break of 27, I'm actually going to do that with a 1-point buy stop reversal, 2-point stop and exit done for the day, because I think they're going to try their best to close shorts and square them and have this market close near its best levels of the session. As far as this intraday action, we've got the Dow up 278 points. Hopefully we'll hit plus 300. The transport's a plus 157. The New York tick is a plus 360. Advanced decline volume is about 20 to 1. So you're getting the maximum impact of this all at once in the New York, and that in itself is a bit of a warning. We're further out of it. But nevertheless, if anybody was doubting it, the Fed is on the correct side. But we haven't doubted it, and we thought the blame game was just a ridiculous one that has been going on out there. And we think that the Fed is responding, not because Mr. Bernanke isn't concerned about inflation, but rather he's responding to the pressures of shall we say, the sort of almost bipolar scenario where you have the credit crunch but inflation. We call it essentially stagflation, though nobody wants to address it thusly. As we look at the dollar index, down 0.43, but that would be expected, though I think the dollar will wash out a little and actually stabilize, particularly if there's a sterling crisis. Be real careful about some of these foreign currencies. That's my opinion. The bonds down 12 ticks at their end today. That is not a surprise. We've been predicting that your intraday response to this would be higher rates, particularly if they lower rates. And you've got the 30-year up 0.46, and you've got the 10-year intraday at 4.480. After spiking up to 4.540 briefly. Crude oil of $1.31 at 79.47. That has nothing to do with demand, has a little to do with the softer dollar, and even more to do with the pressures from the currency, rather from the tensions in the Middle East, where Iran, through their surrogates and proxies, has been basically at war with the civilized world. And that continues. Any way you want to spin it, it simply continues. We'll look at some individual stocks on the final comments later. For now, we bid you a good afternoon. And as we look at the Dow Jones Industrial Average briefly, let's put it on a daily basis. You'll see how we're getting into overbought territory, run in the shorts, have some follow through, and then maybe at least temporarily try to go the other direction. And we hope it's not too negative, but we are still alert. There's your monthly basis chart for something other than the unanimous pleasantries that everybody now automatically seems to assume. Have a great afternoon. We'll be back tonight. Cheers.